Hello, everyone. This is Tom Fox back again with Mike DeBernardis for another episode of Season 2 of The Corruption Files. Mike, welcome back.
Thanks, Tom. And I'm interested in this conversation before my time, but a very interesting one.
Well, Mike, today we're going to take up BCCI, or the Bank of Credit and Commerce International, a bank that was founded in 1972 in Pakistan when the SWIFT banking system was not the ubiquitous worldwide system that it is now. And many countries could not or were not a part of the global financial market. So there was a need for ways to literally send money from places like Pakistan to England to the United States and then back. And so BCCI was set up to service the banking needs of developing countries as well. And at their peak, BCCI had assets of over $20 billion. Unfortunately, the goodwill or the prime reasons for starting the bank really fell apart pretty quickly in the late 70s and early 80s. And BCCI was charged with engaging in money laundering operations, facilitating the transfer of illegal funds for drug cartels, terrorists, and corrupt politicians. When you think about really being a sort of not an off-the-books bank, but an off the international banking system bank, you can see that's going to be problematic. Regulatory evasion, BCCI regularly employed a complex web of shell companies, subsidiaries, and nominees to evade regulatory scrutiny. We'll go into that in a little bit more detail. Insider trading and illegal loans. The bank used unsecured loans to insiders in their businesses, usually without proper documentation. If the loans defaulted, it was only the small users and lenders and borrowers who were damaged. And then really one of the biggest was financing terrorism and illegal arms deals. Interestingly, as we saw in the Lockheed scandal, it was really a congressional investigation which broke this case open. And here's also a name from the past who's still around. John Kerry, when he was a senator, initiated an investigation into BCCI's activities. In 1991, finally, the world's banking system had enough, and regulators in 7 countries, led by the Bank of England and the U.S. Fed, seized BCCI assets and shut it down. There was a series of legal proceedings against the bank, and the bank's assets, as I said, were frozen, and they were eventually taken over. How all of this related to America was the following, Mike. BCCI created a U.S. subsidiary called American Bank Shares. And this was a U.S. bank subject to U.S. banking regulations, but it was secretly owned and controlled by BCCI, and this was not made known to the U.S. regulators. BCCI used various nominees and shell companies to hold the shares of American Bank Shares. They acted as intermediaries, hiding BCCI's direct involvement. BCCI probably could not have been approved for a bank, and even if they had been approved, then, of course, they would have been directly subject to U.S. banking oversight and scrutiny. But by hiding its ownership, BCCI could exercise control over First American without that, pesky regulatory interference. BCCI basically ran the management and placed key individuals in executive positions to ensure their interests were followed. They got one of the most respected lawyers and political advisors in America, a gentleman named Clifford, who had been a part of Washington governmental scene since literally the Roosevelt era, to act as the chairman of the board, and one of his partners, Robert Altman, who was married to Linda Carter, the original Wonder Woman, more on that later, to serve as the bank president and CEO. There were mismanagement at the bank. There was financial transactions that were more insider trading. And the discovery of BCCI's control over First American Bank Shares raised serious concerns about the effectiveness of U.S. banking regulations and the ability of regulators to determine the abuse that they engaged in. There was the bank itself was shut down, but there was a massive criminal trial brought against Clark Clifford and Robert Altman. I'm not sure who in today's DC, Mike, would be that prominent, but someone as large in our lives as Stanley Sporkin. That was the import of Clark Clifford back then. And Robert Altman was his partner and equally held a high position, at least in the DC bar. So they were charged with fraud, with a scheme to deceive U.S. regulators, concealing the ownership of American bank shares by BCCI, accused of making false statement to banking regulators, charged with conspiracy to defraud the United States and making false statements on applications for banking. Clark Clifford was quite old at this time, and he was deemed unfit to stand trial. So Robert Altman went to trial on a multi-month case by the prosecution. He was accused of misrepresentation, evading regulatory oversight, and insider dealings. He, however, was acquitted, and his defense was that he acted in good faith and that he relied on the information and assurances provided by BCCI officials. And he had an opinion of counsel defense, had that legal opinion that supported the legitimacy of his transactions. Linda Carter attended trial every day and sat on the front row with a plunging decollage in front of a jury of 12 men. And I will leave the rest to your imagination. But it was as high profile a trial in the financial world as I could remember, at least up to sort of the WorldCon, Enron, Tyco trials from the early part of this century. The result was the Fed recognized lots of things. They recognized that they had to work with other Western banking systems, Bank of England, European Central Bank, to put together a worldwide system that could bring everyone into it. And they had to do that to try to stop this terrorist financing and money laundering that was as pervasive at BCCI as anything else. Obviously, they didn't stop it entirely, but by trying to put the entire world under one sort of financial banking system, which we now call the SWIFT system, at least they could get everybody under the same tent and start looking. So that was one of the bigger results. The U.S. laws, internal laws around money laundering and banking regulations were tightened up an incredible amount at the time. And while the banking regulators may have understood what was going on a worldwide basis, Mike, this was sort of the first time the American public had an appreciation of what was at stake with the world banking system. And you mentioned when we started this podcast, this, had not been on your radar before. And I think, frankly, that was the way for many Americans. And at the time, all of us were, of course, looking at Wonder Woman. But while we were looking at Wonder Woman, we were wondering, how did this happen? And how could the Fed or the OCC or the Federal Reserve let this happen? And if Altman and Clifford had gone to trial today under these facts, I'm not sure a good faith defense would have worked. I'm not sure an opinion of counsel defense would have worked because opinion of counsel is good if it's right. The opinion of counsel is not right. You should have known. Well, that's the whole reason to get an opinion of counsel. So it also seems to me the opinion of counsel defense has really been tightened up as well. And on a good faith defense, you can't take someone's word at good faith. You have to perform your own due diligence. In an earlier podcast, we talked about Tyco and how they put a process in place to vet third parties. Well, part of that was engaging in due diligence based upon the information you had. Conscious indifference is baked into the FCPA. And I think certainly in your career and my career, that's something that's kind of baked into our consciousness as well, that we have to communicate the clients, you cannot be consciously indifferent. So a lot came out out of this case. And although it may be one that is now over 30 years old, I think it's still resonating with us today.
Yeah, I think so too, actually. And I think there's a lot of parallels to be drawn to what's happening today in different cases, more recent cases. First, I agree with you completely. I think there's an interesting parallel between sort of the defense that Altman offered at trial and the defense that companies initially, during the FCPA enforcement boom, tried to offer with respect to third parties, which is, look, we didn't know. We asked them. They said they were, doing legitimate business, and that it simply doesn't fly. The standard is higher than that now, and I think that's an interesting thought exercise as to if he were, if that trial happened in 2023 rather than 1993, whether the outcome would have been different. But I also think there's some parallels to more recent cases, right? The first thing that popped in my mind, and as I looked into it, I'm not the first one who thought this, was a parallel between this and FTX, in terms of being in an environment that at the time the world didn't know how to quite regulate it. And similar to, I think this is a term I saw you use, either it was in your notes or say that they used, was jurisdictional arbitrage, right? Where they sort of set up everywhere so that they were actually nowhere, right? And there's something similar going on with FTX, where they were, they're kind of in the Bahamas, just kind of all over in some ways, and did that in a way to avoid scrutiny. And then the other parallel, I think, to the FTX case is, and there's a little bit of this in the Theranos scandal as well. Let's find really prominent people to show, to buddy up with, to get involved, because that might take some of the scrutiny off of us, right? Oh, if these really well-respected figures are associated with this company, it must be fine. It's all above board. Even if we have questions about it, it's all above board. At the very least, it buys the companies some additional time. And we saw that with both Theranos and their board of directors, with FTX, and here having, Clifford and Altman gave it an air of legitimacy. Honestly, when you see these very well respected and prominent figures heavily involved.
So we did have some lessons I really wanted to maybe go through. Some of them are compliance, but some of them are also regulatory, which was, I cited several times, lack of effective oversight and regulatory evasion by BCCI. BCCI had an incredibly complex corporate structure. And in a prior episode, we talked about Tyco. Tyco was eventually bought by Johnson Controls. And Johnson Controls had an FCPA enforcement action, not related to the Tyco purchase. But one of the things that struck me about that enforcement action was that the corporate structure in China was so complicated, the auditors couldn't figure it out. Well, if your internal auditors cannot figure out your internal business structure, you've got a problem. And that really showed from BCCI. The regulatory failures, national regulators failed to collaborate, and they really didn't back then. Obviously, we had fraud and falsification of financial statements, money laundering. I don't know if it would be fair to say in the 90s we had weak money laundering controls, because that would say we had any. And now that really came to the fore after 9/11, and the original version of the Bank Secrecy Act was passed. But certainly in the 80s and 90s, AML controls were very, very weak. There were some international sanctions that were violated, particularly around terrorism financing, but a complete failure of internal controls and ineffective board management. Once again, we saw that in the Tyco case. Basically, no risk management strategy was in place. The AML did grow a little bit after this, and they strengthened internal controls. So there was really a lot that came out of this case. And unfortunately, you could almost draw a straight line from the financing of terrorism to 9/11 to literally the passage of the AML Act of 2020, updating the Bank Secrecy Act for the first time in 20 years.
One of the things I found interesting is it seems like from basically from the start or shortly after formation, BCCI had a corporate goal of avoiding regulation. Their structure was done in a way to avoid regulation. We talked about the jurisdictional arbitrage. It was owned by two holding companies. One was in Luxembourg. The other one was in the Cayman Islands. Two jurisdictions that are well known for bank secrecy. The different ways you talk about the complex structure, and part of that was to you make it so complex it becomes virtually impossible to regulate. And I think that's really interesting, and it's I don't want to suggest that companies with complex structures are trying to avoid regulation, because that's simply not true. There are many legitimate reasons why companies have structures and shell companies and holding companies, and but I do think it's something for when you are tasked with at least internally monitoring those types of companies, whether you're an auditor or a compliance professional. It makes your job incredibly more complex. And I do think it's something you need to be aware of and be thinking of as you're going about your duties.
So this case, as I said, really pulled the covers back for a lot of regular Americans on what was going on in the international banking system. The increase in cooperation on the international banking scene at least started here. Obviously, we've had fits and starts, particularly around 9/11 and going forward after that. But I think it really all started way back when with BCCI. And it's a case that I'm glad we had the chance to look at.
Yeah, I agree. I agree with you. I think it's, for me, having not had much knowledge of this prior to looking into it for this podcast, it's really interesting to look at it and sort of see how things have evolved since then. We look at banking now, not to say there's not often serious issues in banking, but as just this really heavily regulated industry worldwide, really, but especially here in the U.S. And it seems like the changes for that started here.
That seems like a good way for us to end this episode, Mike. I can't wait to see what's up next.
Thanks for having me, Tom.